Hey everyone, welcome back to the channel. Today we're breaking down the recent U.S. strike against Iran and, more importantly, what this could mean for the U.S. stock market, oil prices, inflation, interest rates, and your portfolio. Whenever we see military escalation in the Middle East, markets react quickly. But the key question investors should ask is this: is this just short-term volatility, or could this materially change the macroeconomic outlook? Let's dig deeper. First, let's talk about the immediate market reaction. When geopolitical shocks hit, markets typically move into what's called risk-off mode. That usually means equities pull back, oil prices spike, gold rises, and volatility increases. The VIX often jumps 15% to 30% in the first few trading sessions after unexpected military developments. Historically, after events like the 2020 U.S. Iran tensions or the 2022 Russia-Ukraine invasion, the S&P 500 initially dropped between 3% and 8% before stabilizing. In many cases, the sell-off lasted days or weeks, not months, unless it was a broader economic spillover. The most important transmission channel here is oil. Roughly 20% of global oil supply flows through the Strait of Hormuz. Iran itself produces approximately 3 to 3.5 million barrels per day. Any disruption, even just perceived risk, adds a geopolitical premium to crude prices. A $10 increase in oil typically adds roughly 0.2% to 0.4% to headline CPI over time, depending on how long prices remain elevated. If oil moves from, say, $75 to $95 or higher and stays there, that could meaningfully alter inflation expectations. And inflation expectations are critical right now. If higher energy prices push inflation higher again, the Federal Reserve may delay rate cuts or even signal that rates need to stay higher for longer. Every 50 basis point change in expected Fed policy can significantly impact equity valuations, especially growth stocks, where future cash flows are discounted at prevailing interest rates. For example, if the 10-year Treasury yield rises 50 basis points because markets price out rate cuts, high-duration tech stocks could see valuation compression of 5% to 15%, even if earnings remain strong. That brings us to sector impact. Historically, during geopolitical conflicts, energy stocks tend to outperform because higher oil prices boost margins for producers. Defense contractors also often see capital inflows due to expectations of increased military spending. On the other hand, sectors like airlines, cruise operators, and transportation companies can suffer because fuel accounts for 20% to 40% of operating costs in those industries. Consumer discretionary stocks may also struggle if higher gasoline prices reduce household disposable income. The U.S. consumer currently spends about 3% to 4% of income on gasoline. If fuel costs rise sharply, that reduces spending flexibility, particularly for lower-income households, and that can ripple into retail and travel sectors. Another important factor is the bond market. If oil-driven inflation pushes up inflation break-evens, for example, the 5-year break-even rate moving from 2.3% to 2.6%, that signals rising long-term inflation expectations. That could push nominal Treasury yield higher, tightening financial conditions across the economy. Now, here's the key historical perspective. Most geopolitical shocks do not cause long-term bear markets by themselves. For a sustained 20% plus market decline, you usually need a recession, a financial crisis, or a systemic credit event. After the 1991 Gulf War, markets recovered quickly once uncertainty faded. After the 2020 U.S. Iran strike escalation, the S&P 500 resumed its upward trend within weeks. Even after the initial shock of Russia's invasion of Ukraine, U.S. equities stabilized once the economic impact became clearer. The difference maker is duration and escalation. If this remains a limited strike with no disruption to oil supply, markets may treat it as a volatility event rather than a structural shift. But if there is sustained disruption to shipping lanes or energy exports, and oil stays above $100 for months, then the macro outlook changes. That would likely slow global growth, raise inflation, and pressure corporate margins. So, what should investors monitor right now? First, watch oil prices, especially whether crude sustains elevated levels or pulls back. Second, Monitor the 10-year Treasury yield and inflation break-evens for signs of shifting expectations. Third, pay attention to Federal Reserve commentary. Any shift toward a more hawkish tone would matter. And fourth, watch for escalation signals. Markets price probability very quickly. Short-term volatility is almost guaranteed. Medium-term, the impact depends entirely on whether this becomes a contained geopolitical event or evolves into a broader supply shock. As long-term investors, discipline matters more than headlines. Historically, panic selling during geopolitical shocks has often proven costly once markets stabilize. If you found this deeper breakdown helpful, please give this video a thumbs up. It really helps the channel grow. And don't forget to subscribe so you don't miss future analysis on market risks, macro trends, and stock opportunities. Thank you so much for watching, and I'll see you in the next video.